Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone. This is November 17, 2025. This is your weekly market insights with Northbound Wealth Management. The S&P 500 index edged up 0.1% this past week, as gains led by healthcare and energy stocks slightly outweighed declines in sectors including consumer discretionary and utilities. The market benchmark ended Friday's session at 6,734.11 and is still in the red for November with a month-to-date drop of 1.6%. The index is up 14% for the year. This week featured the end of a 43-day government shutdown, the longest federal closure in U.S. history. While the government has reopened, investors are still awaiting the resumption of a number of key economic reports, including employment data for September, which is scheduled to be released on November 20th, and October data. As earnings season winds down, questions loom over what the delayed economic reports may show and how they may impact the Federal Reserve's policy setting meeting in December. The healthcare sector had the largest percentage increase this week, climbing 3.9%, followed by a 2.5% rise in energy and a 0.9% increase in materials. The consumer staples and technology sectors also eked out weekly gains. Eli Lilly was the best performer in healthcare, rising 11% on the week, amid news the company will be partnering with MeiraGTx or MGTX to develop and commercialize genetic therapies for eye diseases. Under the company's agreement, MGTX will give Eli Lilly global rights to its AAV-AIPL1 program, which targets Leber congenital amaurosis for a severe inherited eye disorder. Leerink Partners upgraded its investment rating on Eli Lilly stock to outperform from market perform. The energy sector's top gainer was Devon Energy, which rose 6.4% on the week with continued aftermath of its better-than-expected Q3 report last week. Devon Energy is positioned to deliver stable operations in 2026 while benefiting from improved capital efficiency and ongoing optimization, RBC Capital Markets said Tuesday in a report. On the downside, consumer discretionary fell 2.7%, followed by a 1.2% drop in utilities and declines of 0.9% each in real estate and industrials. Communication services and financials also edged lower. Williams-Sonoma had the largest percentage drop in the consumer discretionary sector this week, falling 7.5%. This comes ahead of the company's next quarterly report, which is set to be released on Wednesday, November 19th. Other companies set to release quarterly results this upcoming week include Home Depot, Medtronic, NVIDIA, that's a big one on Wednesday, TJX, Palo Alto Networks, Lowe's, Target, Walmart, Intuit, and BJ Wholesale Club. Beyond the November 20th release of September employment data, the schedule of economic reports remains unclear as the government works to resume releasing data following its 43-day shutdown. Thank you, Y-Charts, for this information, and we'll dive into performance here today here in just a second. So thank you, Y-Charts, for this information as well. We're talking about the Dow Jones Industrial Average year-to-date trailing number is 13.12% to the positive. S&P 500 is up 15.8% to the positive. NASDAQ is up 19.07. MSCI EFA index, which tracks developed overseas stock markets, is up 29.82% year-to-date trailing. That is kicking the crap out of the U.S. markets. You actually have a bid internationally. 10-year Treasury note is 4.14%. That's up 2.73% from 4.03% a month ago, but yet down 3.5% over the last 3 months from 4.29 and then 4.43 respectively a year ago. That's down about 6.55%. So trading around 4.14 in that lower four handle range. Okay. Again, thank you, Y Charts, for that information. This week, key economic data. Again, Monday, there's a bunch of Fed heads talking this week. I'm not going to go over all of that. But we're going to be tracking some import prices for October, industrial production, home builder confidence, housing. That's like Tuesday, Wednesday, building permits, FOMC minutes from October's meeting. A lot of stuff going on with that. So we're going to be following it, tracking it, and trading around that and talking to you guys. So, tax tip of the week: you have the right to retain representation when working with the IRS. As part of the Taxpayer Bill of Rights, you have the right to retain an authorized representative to represent you when dealing with the IRS. If you can't afford representation, seek help from a low income taxpayer clinic, which is called LITC clinic, right? I guess. An authorized representative can represent you in interviews, audits, appeals, and tax collection disputes with the IRS and in court. Authorized representatives include attorneys, CPAs, enrolled agents, enrolled actuaries, or any other person who has submitted a written power of attorney to represent you. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. Stay tuned for the next segment. So, on Wednesday, NVIDIA is going to report earnings. The headline on CNBC is NVIDIA CEO Jensen Huang surprised investors with $500 billion forecast. It'll come up at earnings. So basically, NVIDIA says that revealed in October that his company has $500 billion in orders in 2025 and 2026 combined for its chips. They're at the heart of the AI boom. Analysts say the data points signals meaningfully higher 2026 sales than previously expected. And that is really substantial for a company that has seen its quarterly revenue grow nearly 600% over the past 4 years. Jensen Huang's statement was a sign that NVIDIA is confident of another year of strong but slowing growth for its next cycle of chips, implying that the AI boom still has room to run. Quote, this is how much business is on the books, $500 billion worth so far, end quote. Huang said at the GTC conference in Washington. It's incredible. So Huang included 2025 revenue so far, sales of NVIDIA current Blackwell graphics processing units and next year's Rubin GPUs, and also related parts like networking. After parsing through the details of Huang's remarks, analysts concluded that the statement signaled a meaningfully higher year by revenue in 2026 than Wall Street had previously expected. So, a lot of analysts are, and everyone, basically the world, is looking forward to hearing what they have to say on Wednesday. JP Morgan has an overweight price target of $215. That's significantly higher than where it's trading at right now. And they believe that NVIDIA continues to execute across all their segments. While the first half is typically seasonally weaker than the second half, we expect solid demand in the PC gaming to be strong revenue driver for the company, offsetting PC OEM, which is in secular decline. We expect data center segment to grow strongly as hyperscale customers continue to embrace GPU, accelerated deep learning for processing large data sets. We are encouraged by strength in the automotive and enterprise segments as well. Although strong adoption of autonomous driving in the market remains to be seen, we anticipate significant upside in shares driving our overweight rating. So valuation, the price target assumes NVIDIA trades at a 30 times in line with its longer term EPS growth rate. So that's a 30 times multiple, and annual earnings power of $7.15. So $7.15. That would be $1.73 plus $1.85 times 2. Risk to the price target for a lot of analysts, including the one from JP Morgan, Harlan Sur, is although PC gaming demand seems resilient to macroeconomic weakness, any macro uncertainty could weigh on PC gaming demand trends, given NVIDIA's about 53% exposure to the PC gaming segment. Any consumer PC gaming weakness poses downside risk to our estimates. NVIDIA's GPUs could gain lower than expected deployment into data center applications as hyperscale customers further adopt deep learning as a new and effective way of processing large unstructured data sets. Any significant decrease in the adoption of deep learning by hyperscale customers or increase in competition could result in downside risk to our revenue and earnings estimates, Harlan Sur said at JP Morgan. So 215 price target. I happen to believe that they're in the lead as far as competition above Broadcom and AMD advanced micro devices. So I'm excited about actually all of those guys in the semiconductor space as the hyperscaling and growth for data centers accelerates in the coming years. All right, that is what I have for NVIDIA. We'll circle back once earnings happens, and we'll see how the stock price reacts in the markets. Again, not advice. Consult your financial professional. There's a new blog by Catherine Woods, ARK Investments and ARK Investment Research. And I wanted to share this one with you because if you're interested in where future technologies and innovations are going, this is a good blog or good article to look up. So go out there, look at arkinvest.com, and sign up for their blog. This comes from their research. So I get a email quite often from them, and I try to stay up on things via their piece because they do a lot of investing on the front end of the future and innovation space. So I find it very interesting, and I thought I'd share it on this week's segment. The FDA new plausible mechanism pathway could transform therapies for rare diseases. This article, this one was written by Shay Wilborg, and she's a research analyst and did a great job on it. 2 weeks ago, the U.S. Food and Drug Administration Chief Medical and Science Officer, Dr. Vinay Prasad, previewed a plausible mechanism pathway to accelerate the delivery of bespoke therapies, published in the New England Journal of Medicine last week. The FDA's paper provides an early blueprint for this future. The FDA's bold regulatory shift recognizes that families of rare disease patients have understood for years. The biology associated with many genetic conditions is well established. With this new approach to support a marketing authorization, the FDA is likely to accept streamlined evidence, including data generated across several consecutive patients when both the genetic cause of a rare disease is known and a therapy targets it directly. The FDA is responding to lessons learned earlier from this year from baby KJ, the infant who received a first-in-kind custom gene editing treatment for a rare metabolic disorder. KJ's story captured global attention and stirred both hope and heartbreak in families whose children face similarly devastating diagnoses. Prasad's move suggests that the FDA understands that baby KJ's case was not a fluke, and that soon more patients might gain access to previously unimaginable therapeutic options. The implications for the healthcare industry are profound. Instead of waiting years to populate and collect data in rare disease trials, companies should be able to advance modular therapeutic platforms that scale across many genetic variants by relying on shared mechanisms of action, chemistry, and manufacturing. In such cases, evidence of biological plausibility, target engagement, and clinical improvement could enable therapies to move from treatment of just a few patients to many patients, potentially compressing drug development timelines dramatically. Importantly, the new framework may not be limited to rare diseases. While prioritizing pediatric, fatal, and severely disabling genetic conditions, the FDA also acknowledges the potential to expand it to common diseases, particularly those lacking effective treatments, and to model modalities beyond gene editing, including small molecules and antibodies. While the FDA is yet to provide formal guidance about this pathway in practice, the direction is unmistakable. Regulators are trying to catch up to the pace of scientific progress and address the urgent unmet needs of patients who cannot wait a decade for trials to read out. This next one is early adopters are selling Bitcoin as institutions are buying. So this one's by David Puel of ARK Invest, research trading analyst, associate portfolio manager of digital assets. This year, the price of Bitcoin has been buffeted by a battle between early adopters and institutions. So-called whales have been selling while public companies and ETFs have been buying. Indeed, this dynamic has characterized this bull cycle. Quote, liveliness, end quote, is a metric that captures this phenomenon. Liveliness measures the ratio of total coin days destroyed relative to total coin days ever created. It rises when long dormant coins make a move on chain and falls when holders are inactive. At 0.89, that's a decimal, it's 0.89, its highest level since 2018, liveliness suggests that longer-term holders have been taking profits at the highest rate since 2021, as shown below. And there's a chart in this blog piece I'm not going to go over. But while early adopters have distributed liquidity, institutional demand seems to have absorbed it, or vaulted supply, meaning stagnant coins, have declined throughout the bull market, as shown in the chart below. And they have a chart of vaulted supply of Bitcoin or BTC in the start of 24, 25, and then as of November 15, 2025, and it's declined from, it looks like 8 million down to 7,318,000 coins. Conversely, institutional balances have surged. The number of Bitcoins in U.S. spot ETFs has increased, obviously, with IteBit, which is BlackRock's, and then Grayscale's, and Bitwise, which is BITW. So it's interesting. Public company Bitcoin holdings, including digital asset treasuries, DATSs or DATs, have increased as shown below. So it looks like from 2024, 271,000 BTCs or Bitcoins at the start of the year. And then as of November 15th, you got 1,056,000 plus and growing. Combined ETF and public company holdings reached about nearly 2.4 million BTC as of November 15th. And that just isn't suggesting that institutional demand has offset early adopter sell pressure. Year-to-date data suggests the same. So together, these data suggest a structural transfer of Bitcoin supply from longtime holders to institutions, initiating positions in a new asset class. Though year-end and in 2026, given the sensitivity of institutions to changing in dollar liquidity, the end of quantitative tightening and lower interest rates, both of which what they believe should bode well for BTC or Bitcoin. All right, on to the next subject that they cover in the ARK Invest piece, and it's called, When Are Humanoid Robots Likely to Impact Our Lives? And this article piece was written by Akash TK. So he's a research associate at ARK Invest. ARK's research suggests that humanoid robots will reach human-level performance in 2029. So get ready for that, you guys. As ARK's chief futurist, Brent Winton, noted recently, the difference in the difficulty of scaling autonomous robotaxis and general-purpose humanoid robots will not be incremental. Informed by Tesla's AI compute scaling, our research suggests that humanoid robots will be around 200,000 times more complex to scale than robotaxis have been. Fundamentally, autonomous mobility is a function of compute and performance. In robotaxis, the higher the investment in compute, the higher the number of miles between interventions. By regressing that relationship, we have modeled the nonlinear amount of compute required for each order of magnitude improvement in autonomy, as shown below. So they've charted that out very nicely. Picture's worth 1,000 words. So obviously go out and sign up for the blog and get that piece. Musk contends that Musk, what he's talking about is Elon Musk, contends that full self-driving FSD, okay, that's the acronym, full self-driving, must exceed human performance, represented by the dashed circle in the chart, before robotaxis will scale. Humanoid autonomy should follow a similar path. Our estimated 200,000 times complexity ratio represents the degree of perfection a humanoid robot will have to achieve before operating reliably in the real world. Based on our established AI improvement curve, the graph above highlights the enormous compute that will be necessary to solve an autonomy challenge 200,000 times more complex than robotaxis. According to our research, humanoids will be capable of human-level performance across varied tasks in 2029. So, guys, that's like 4 to 5 years from now, okay? 4 years from now. Basically, we're towards the end of 25. So here we go. Buckle up. While commercial sales of early-stage limited function robots could begin in the next few years, generalized performance will demand much more investment in compute, $150 billion at the very least. Did you hear that? Wow, that's huge. And Elon Musk just got a $1 trillion pay package, which apparently did not have the calculus of the humanoids within it. It was just all the other four other things that he's focused on, not the humanoids. So if that actually does come to pass in the next decade, he'll definitely be at that $1 trillion value pay package and be able to monetize that for himself. There's a lot of source articles that support this information, and I'll put some of that information in the show notes for you guys to follow it if you follow this podcast. So there you have it. I would definitely be subscribing to this going forward and reading it on a periodic basis because they are on the leading edge, and I like to know what's going on out there. All right, thought I'd share that with you. It's very interesting. Stay tuned for the next segment. The end of the year presents unique opportunities for financial strategy decisions. Here are a few smart moves to consider before December 31st that could make a real difference, according to Plan Corp's Ultimate Checklist. Number 1, use the IRS withholding estimator to see if you might need to make a final estimated payment by January 15th. Number 2, consider rebalancing your portfolio and exploring tax loss harvesting before December 31st. Number 3, review your FSA contributions. Remember, FSAs may be use it or lose it, so you got to make sure you use it. And number 4, consider boosting your college savings while making the most of the annual gift exclusion. Year-end preparation isn't about adding more to your to-do list. It's about making small, timely moves that can have a lasting impact. Taking an hour now can help you start 2026 confident and prepared. If any of these ideas create some interest, or if you have some of your own, we might be able to share some additional information with you. But we would encourage you to check in with your tax, legal, or accounting professional before making any changes, or you can reach out to Northbound Wealth Management, 317-399-1107. So, climbing a wall of worry. There is always something to worry about when investing. In fact, there's even a saying about it. Wall Street climbs a wall of worry. Some people believe, I'll wait until it gets resolved. But remember, those were the same people who, in the spring of this year, suggested, I'm going to the sidelines until the tariff issues gets resolved. Since May, stock prices have advanced for 6 consecutive months despite unresolved tariff issues. Taking the temperature. Investors remain fearful despite a powerful 6-month rally in stocks. And so, the old adage that Warren Buffett said is, be greedy when others are fearful and fearful when others are greedy. Words of wisdom from beloved Warren Buffett. And if you have a good strategy and you've built a nice diversified asset allocation that aligns with your goals and objectives, stay the course through those bouts of volatility and bouts of pundits propagating fear. And if you're fearful, there are people here. A financial professional can help. Northbound Wealth Management, that's what we do. So stay tuned for the next segment.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.